Good morning, everybody, and you're all very welcome to our next webinar in our series. We've been running these webinars now for the last, a year and a half already, almost. And we're delighted to have you here in such good numbers this morning. My name is Aidan Shine. I'm CEO of Southeast BIC. And our theme this morning is financial planning for investments. So it's a theme very close to our heart here in the BIC. We have a phrase we use internally as a team that great startups don't fund themselves. So at some stage along the journey, if you're going to grow and scale an innovative business, you're going to have to raise money either from public or private sources. So as well as having a great idea, a great problem to solve, a good business proposition, you also need a good set of financial projections. And I suppose the reason we're running this webinar today is that oftentimes we feel that financial planning and financial projections, a lot of promoters, there's a great fear factor around them, and that they kind of get pushed to the bottom of the list. So a lot of focus is on, and rightly so, on the minimal viable product, on customer discovery, getting that first customer, and the financials then are kind of left to the last in the whole process. And it's something that we're trying to, I suppose, demystify a little bit here this morning. And to that end, we've got a great panel with us here today, more of which anon. So just to kind of give a little overview of what's going to happen, I'm just going to give a brief overview of the BIC and what we do. Some of you have been regular attenders on our webinar, so you know what we do, but just for the newbies, and I'd also refer you onto our website as well for more information. And then we're delighted to have Terry Smith from Enterprise Ireland, and Terry will give a brief overview of what supports Enterprise Ireland are providing to startups and promoters. And Gary Layton is here from the Halo Business Angel Network, and Gary will explain how they manage, HBAN manages a network of angels that invest in startups throughout the island of Ireland. And last but not least, we have Dennis Breen, the Managing Director of ProfitPal. So Dennis will be able to give us his view of what ProfitPal does, but also around the financials and the preparation of financials. And then we'll open it up to a broad discussion amongst the panelists. And I would encourage those of you logged on this morning to use the Q&A box, ask questions as we're going through that. Rather than me asking questions of the panelists, we can get your questions direct to them as well. And any questions we don't get to during the formal part of the discussion, we'll leave room at the end for a Q&A session. We're aiming to have it all done and dusted within an hour. We believe in efficiency and that your time is very precious, so we think an hour will give us enough time to have a good discussion on the topic here this morning. So just as I quickly introduce the panelists there, just a quick overview of actually with the panelists, I suppose, before I go on. I suppose Terry, just to give you a bit more information on them, Terry Smith is the manager in the Enterprise Ireland High Potential Startup Division, leading the development of early stage innovative companies with scalable international growth potential. She is a passionate supporter of entrepreneurship and has 20 years experience in business development and investment roles within Enterprise Ireland. And she also held technical and commercial development roles in retail buying and product and brand development. Gary is an investment consultant for HBAN, the Halo Business Angel Network, sourcing and selecting investor-ready deal flow for a network of over 700 business angels. Gary has been a leader in the startup and innovation space in Ireland for over a decade now, providing the commercial leadership at NDRC, where he invested in over 300 early stage ventures. Dennis is the MD of ProfitPal Accountants for over 15 years. 8 years ago, they pivoted from being a general accountancy practice to one which served the tech community specifically. And for the last 8 years, this has involved extensive experience with founders who are fundraising both private and public funds. So we're delighted to have you on board, guys. You can turn on your cameras now and let people see you in person. And all of these individuals here with us this morning have great knowledge to impart on the whole idea of financial planning for investment. So before we get into the panel thing, just a couple of minutes, if I may, on Southeast BIC and what we do. So we've been supporting entrepreneurs, promoters and startups in the Southeast region for 25 years now. We were founded back in 1995. We're a public-private partnership and not-for-profit organisation. And we receive most of our funding from Enterprise Ireland to work with innovative startups and promoters, specifically in our region. And we work really, really closely with the local enterprise offices and Enterprise Ireland in developing the startup and entrepreneurial ecosystem here in the Southeast. And how we do that, as I, at the start, I used the phrase, great startups don't fund themselves. Everything we do in the BIC is on an individual, customized, client-focused basis. So we deal with clients individually. So we're not trainers as such. It's everything is kind of one-to-one consultancy. And we take clients through that investor-ready journey. So starting there on the left-hand side, the feasibility side, we work very closely at the start, developing business models, revenue models, route to market planning, to make sure that the business model kind of stacks up from the get-go, and then migrate into the investor readiness phase. That's more in-depth, more action planning, more business plan development, getting the clients ready to go look for investment. And that can be from Enterprise Ireland with their competitive start fund, high potential startup funding, HBAN for angel investment, seed funds, or ultimately VC funding. So today's team is very much ties in with the work that the BIC does in getting clients investor ready and making sure that everything is done in a way that enables the company to access the funds that are available. And that's why we want to focus a little bit today on the financial planning aspect. We've done an awful lot on business modeling, on route to market and marketing and branding, customer discovery, and you can look back on our YouTube channel and see those. But today it's the turn of financial planning, which we think should be earlier in the process, possibly in terms of a startup, and it should be on an equal footing, MVP development and customer discovery. All other information can be got on our website, southeastbic.ie, or give us a call, and we can see how we can assist you as well. So, to our panelists, I'm delighted to have the three of you here today. Hi Terry, hi Gary, hi Dennis. Have your mics on? Good stuff, good stuff. Yeah. So Terry, if we could start with yourself, and for the next 5 minutes or so, just tell us about your role in EI, maybe, and some of the supports that EI are currently making available to startups in all over in the Southeast, but in Ireland in particular, I suppose.
Okay, thank you, Aidan. So good morning, everyone. I'm delighted to be part of this panel here this morning. My name is Terry Smith, and I'm a manager in the High Potential Startup division in Enterprise Ireland. So for anyone who's not aware, Enterprise Ireland is the government agency that supports innovative companies in manufacturing and international traded service, very much focused on supporting export-led companies, and we support not only startups but companies that are more established, scaling, and large companies as well that are going to be beyond the SME stage. So on the startup side, we invested 48 million in startups last year. In my role, I work very much on the early stage startup side. So on the onboarding side, we would liaise quite closely with local enterprise, New Frontiers. We work closely with the BICs as well in terms of prospecting and onboarding new clients. So companies at that early stage. The support structures for a HPSU, generally we define it as from incorporation up to 5 years from incorporation is generally the definition period for high potential startup type support. But companies that grow then can progress towards our more established supports. So on the high potential startup side, typical what we call pre-seed or pre-HPSU investment supports are the Competitive Start Fund, and I'm delighted to announce that we will be opening a new fund called for applications next Tuesday. It will be open for 3 weeks. So that in particular is for companies that have minimum viable product, are at that early pre-seed stage, maybe have some market traction, and have the research done to show that the opportunity is there, that their product or their service has the potential to grow. So we have potentially to fund up to 20 companies under that fund. And I know Aidan and the team will be organising some training workshops and briefing sessions over the next couple of weeks for anyone who's interested in that particular fund. We also co-fund at the seed stage. So in terms of the pathway, we co-fund in what we call a HPSU investment. That's generally a seed stage investment, and typically we match external investment. But we are conscious that in the current climate, some companies may need a little bit of flexibility around that model. So anyone who's an Enterprise Ireland HPSU client, please work closely with your development advisor in terms of discussing your funding needs. At the post-seed or the post-HPSU seed investment stage, we also support in terms of follow-on supports, some follow-on investments. And last year we introduced the Sustaining Enterprise Fund equity product, particularly for HPSU companies that we've already invested in. So in addition to the investment side, we also have smaller grant supports. Typically, feasibility, we do some key person support. So it's not always just about the investment or the finance. We also support companies in terms of training initiatives, links to experts in the market. We've 40 overseas offices as well. So it's about the funding structure and also supporting in terms of services and network and contacts. So that's it in a nutshell, Aidan. So I'd certainly reach out to anyone who's interested in starting up, maybe to link in with your local BIC. And if you think you've got an export-led opportunity, to contact my team at hpsu-inquiries@enterprise-ireland.com. Thank you.
Yeah, brilliant. And I don't envy you, Terry. There's such a wide variety of supports from Enterprise Ireland, trying to cover those in a few minutes. So that was really well done there. That in fairness, Enterprise Ireland, and through the whole COVID pandemic crisis that we've been and still are probably to a certain extent living through, the supports that Enterprise Ireland landed so quickly into the ecosystem and in the helping companies sustain themselves during the pandemic was really good as well. Gary, you're very welcome.
Thanks, Aidan.
And if you would like to just give us an overview of HBAN, the Halo Business Angel Network, and what work you guys do with startups on an all-island basis, I must add as well.
Yeah, I suppose that's probably the first point. So HBAN is an all-island network. It's funded by Enterprise Ireland, Intertrade Ireland, and Invest NI. And it really is to increase the participation of angel investors in the ecosystem. HBAN is effectively a matchmaker. So we're matchmaking what we believe to be very strong investor-ready entrepreneurs with a strong network of investors who have a real appetite to invest at the early stage in companies. Last year, it's probably worth just looking at some of the figures. HBAN would have invested over 14 million euro in early stage companies. That would have been over almost 60 investment deals. And the average investment per company was about 250,000. HBAN angels tend to participate alongside other investors as well. So Enterprise Ireland would be a co-investor in those companies, as would many of the institutional seed funds that you see in the ecosystem as well. We operate 5 regional networks, or almost 6 regional networks now around the country. One of which is in the southeast, operated out of Southeast BIC, and that represents almost 15 angel groups. 10 of which are syndicates. So they are syndicates that have come together to actively invest as a group rather than just individuals. And we also have a number of international syndicates as well. So expat Irish people living abroad who want to invest in Irish companies. So we have syndicates in London. We have the one in Singapore. We're starting one in Dubai. We're even talking to somebody in Vietnam recently. So there's active support from the international community as well, looking to invest in companies here. I suppose my role is really around deal flow. So it is identifying those entrepreneurs who are ready for investment, and then getting them ready to present to the network. And how we present them to the network tends to be through pitch events. So every month we're running pitch events where we present 4 or 5 opportunities to the network of angels throughout the country, and then manage that process through to term sheet negotiation and actually conclusion of investment.
Okay. And we hasten to add, Gary, that those pitching events, even though we use the phrase Dragon's Den sometimes in order to explain, it's nothing like Dragon's Den, I suppose, in real life, just in case people are wondering, about the equity levels and stuff like that. Okay, Dennis, last but not least, we just like to hear the Profit Pal story as a starting point, Dennis, and I'm intrigued with the pivot that you undertook as well at one stage. Maybe you can incorporate that into the story as well.
Sure. Thanks, Aidan, and good morning, everyone. Thanks for having me on the panel. Yeah, my name is Dennis Breen. So I run what was a traditional accountancy firm, and we dealt with pretty much all retrospective compliance requirements. And we decided about 8-9 years ago that that really kind of wasn't really fulfilling what we really wanted to do, which was help businesses operate. And we started looking at a whole variety of online accounting systems and bringing that kind of in a forward focused and real-time perspective to clients. And as that progressed, then we realized that the clients that needed that the most were typically clients that had taken on investment funding. So they had third parties who had parted with their cash and had invested into a vehicle and wanted transparency and wanted overview and wanted the ability for that firm to be able to demonstrate to them how they were proceeding and whether there was going to be a return on capital. So we essentially then started looking after those tech companies more and more, and the VCs started to come on board and say, look, you guys are kind of providing this function. We were doing it and strangling ourselves at the same time because we were trying to apply it like a retrospective accounting firm would, which is we would do it after it finished. And that had to change. So everything had to go digital and had to be real time. So we now have 13, 14 people who are simply just chopping away at accounts all day long, sort of through the month, so that you can close your books rapidly at month end, and everything is online. So we're able to actually turn around the process very, very quickly. We look at it like an internal finance function. So we assign people the exact same way you would in a finance function, where you have your initial bookkeepers or data capture, staff accountants, controller, CFO, FP&A person, and potentially treasury also. So you bring that vertical sort of roles to the people, which is effectively fractional roles to a company that, while it's relatively small, has large company characteristics. And some of these companies then might have a sales department in Australia or the States. So we do the finance for them also. We run their accounting system. We make sure it all kind of comes back in under one roof and is able to then flow into projections. And every company gets a monthly board report at the end of the month. So as a result, more and more tech companies that fill that characteristic need started to come to us. So we deal with over 70 tech companies, and we run the finance function for around 50 of them. Some of the larger ones that we do, and from all sizes. So we, from one or two founders starting out, just trying to get a handle on where they're going, to large companies like Pointy, Bright Flag, Glowfox, Pagefair previously, Social Talent, Newswhip. We run the entire finance function for them, and they would typically then layer in at particular stages a full-time CFO, but they will try and keep a very lean financial footprint in order to be able to fulfill that sort of the skill needs at the various stages, but still be able to then reinvest the funds into their product and into their sales and marketing side and fulfill all their finance needs. So I suppose I spent 10 years prior to starting this in San Francisco. I ran the finance FP&A for a large commercial finance public company, did treasury, debt management, all of that. So a lot of that sort of fed into it in a slightly different world, because because commercial finance, there's valuation, we were doing it all the time. But it's not like tech valuation where there's a large gray area. It was very specific to return on investment. It was very specific to capital asset and what you could get back out of it, and your cost of capital was crucially important. So when I look at tech valuations, I often sort of think, really, like how do we arrive at this, or how does this? And I suppose I can talk to it later in the program. But your financial projections really kind of underpin that also. So I think they're crucial to the overall story. And I suppose that's what we do.
Brilliant. Brilliant. Thanks, Dennis. Thanks so much for that. Just to kick off then the panel discussion, and without getting too basic, but I think it's a good starting point. And Dennis, as the accountant here, I'll go to you first. A set of projections. What do they look like? What are they made up of? What are the documents that make up a good set of financial projections? It's something probably people think they do know, we all do know, but just to kind of lay it out there for people, if you're preparing a set of projections, what's the expectation at the end of it? What's the output?
So it depends on where you're starting from. If you're starting from a position where you already have some track record and you have actuals, then typically your projections have to link in with those actuals. If you're starting with a white sheet of paper and you're saying, look, it's all projections, then obviously it is all projections. But you've got to get a couple of things right with regards to it. First, the outputs are going to be unit metrics, a profit and loss account, a balance sheet, and a cash flow. And what we typically see is people come at it from a cash flow perspective initially, and they try to re-engineer then a profit and loss and a balance sheet out of it, and they get lost into how to do that. So you find the flow of those three documents very difficult to manage. And they're also then not linked to, let's say, the unit metrics of what they are actually building. And that's crucially important, because whatever projections you have, you need to have variability in them. You need to be able to test them and be able to sort of tweak the numbers and not have to re-engineer the entire projections every single time you do it. So you're going to live in a spreadsheet model. That's for sure, whether it's Google Sheets or Excel. That's a certainty. You're not really going to go to forecasting software at this early stage. You're going to stay in spreadsheets. You're going to try and map out your unit metrics as to, look, what are you selling things for? What's your gross margin, if there is a gross margin, and what are your kind of the variables around variable costs or fixed costs that might be associated with it. Try and get something down. At the end of the day, I think you also have to bear in mind, you're walking into a room nearly always with back of the envelope individuals who are going to assess your projections from a back of the envelope perspective, which is they are going to have 4 or 5 key questions that will be able to put a structure and a mechanism around whether your financials stack up. So, this has happened to me on numerous occasions where I spent weeks putting together financial projections, only to walk into a meeting and get pulled apart by a number of people who have spent minutes looking at those projections, because they are going straight in on the key commercial aspects of the projections. And I've spent so much time on the mechanics that I haven't actually stepped back enough and, with a critical eye, try to understand, well, what is this saying to me? So you get destroyed in a meeting. It's like, it's terrible, but it's a good learning curve too. So I would encourage anyone who's doing financial projections to also have a back of the envelope approach to it, where they say, look, if I change my margin by this, what do I expect my profit or my cash flow to result? If I change this by that, what would happen here? And get somebody to sort of critically assess that also. But they're your main documents.
And within the context of that, and I'll get to Terry and Gary in a second, people are constantly saying to us, Aidan, look, nobody could have forecasted COVID, for example. What's the point of doing 3-year projections? How long, where's the effectiveness in terms of the horizon that you're kind of looking at, and beyond maybe 12 months, is it total pie in the sky in terms of financial projections?
No, it's not. It is and it isn't. What projections are trying to do is they're trying to take the passion and the purpose that you have around your product and your market fit, and they're trying to demonstrate that there's a business in there also, and you have thought this out. So they're trying to get you to critically evaluate, the passion that you have, that you can distill and you can impart as to what you're going to build and what problem it's going to solve. So unfortunately, it's the cold element of it, and it's certainly the element that people might not want to go to straight away, because it doesn't really, like, financial projections are not exactly the warmest and fuzziest thing to spend your time on, but they do make sure that you've got a description, at least in a roadmap, that you can demonstrate to others, especially third parties who are going to part with their hard-earned cash into your business, that there is a mechanism for a return on investment here, and here's what it is. And then your projections, like, you'll see so many projections that will be hockey stick with regards to, we start off with no revenue and then it's to the moon. But there's a story within that also, which is, well, when do you think potential funding rounds are coming around, and how much do you get in a funding round, and what will you use it for over what time period? So I see a lot of errors in financial projections around, well, we want to raise €1 million, but we're going to burn through 4 million in the next 3 years, and then we'll think about our next round. Like, you're not going to get 3 years out of it. So you need to start thinking of your financial plan in a business-like manner. It's very important. Also, though, start with the back of the envelope. Know where you actually think your financials are going to go, and then start to build a financial plan around it.
Okay. But the message, we're still projecting 3 years out, is that the step would typically be 3 years out.
Absolutely. I just finished a 10-year plan yesterday, and I was trying to say to them, look, 10 years is like, once you're at 12 months. But the idea is that they've got a lot. You have to look at the motivation of the investors who are coming in, and if the investors who are coming in and their motivation and purpose is a 3-year, 5-year, 10-year horizon, and I think it's important to start demonstrating that you're on the same page with them for the same investment horizon. So, everyone appreciates that once you get past a certain period of time, you're into I don't know stage. But you've got to be able to demonstrate the construct that you get it and that you are business-like in your process. If you're not business-like in your process, it raises question marks around, well, what else? Have you missed something else?
Okay, thanks, Dennis. And Gary, from a HBAN perspective, then what's the expectation levels in terms of projections? What does HBAN Angels expect in terms of the financial projections pack that arrives as part of the whole pitch?
Yeah, so I think it's broadly the same. It's a 3-year horizon. It's cash flows, it's balance sheet, it's P&L. But I think what's really important to understand is the credibility that you're building as a founder with the prospective investors. So you've probably excited them with your business plan. So that's all qualitative. You've told them a great story, an amazing problem you're going to fix. But there's lots of assumptions in that, and founders are more than happy to talk about those. But what you have to show is the quantitative assumptions that you're making, and that's what feeds into your financial model, and that's the stuff that people will want to dig into, as well as the business plan. And if you present poor or flawed financial model, that's saying something about you and how you're going to run your business going forward, and that's where you start to lose credibility, and that's where things start to fall apart. So they will dig into things like, okay, that's a great idea, but how much is it going to cost to build that? And really understand the assumptions that you've made around that, which we all know are just your best guesses as of today. But they want to know that you've thought that through, and you've looked at it from a couple of different angles and created a few different scenarios to say, look, we think this is our best guess at the moment. But they'll also want to understand with how much you think it's going to cost to acquire customers and to sell this. And what are your assumptions around that? And then as a model, does it stack up? So can you charge a lot more than what it's going to cost you to bring to market? And actually breaking that down. And there should be complete alignment between your qualitative statements in your business plan and the quantitative statements that you're making through your...
Yeah, we see that a lot, that a promoter can eloquently express what's going to happen in the business, but if you ask them to put it into numbers, they kind of fall apart a little bit. They don't seem to equate the two, that that one is just an expression of the other.
And personally, I find it very frustrating when I see, and no offense, Dennis, but when a founder completely outsources, or in my view, abdicates building a financial model. And it's no problem bringing in a professional to work with you to build that financial model, but you're the only one that can contribute to that and put the inputs into it. And as a founder, you need to know your financial model inside and out, so that when you're sitting in that room with that investor who wants to write a check for 250,000, that you can answer all those questions. Looking over your shoulder to your outsourced CFO to explain it doesn't build confidence in a founder.
Okay, cool. Gary, and Terry, from an EI perspective, then I presume it's largely the same in terms of the expectations around what the projections, but I think you've got, for HBCU, for example, you've got particular levels that the projections need to probably show, or the ambition needs to show in terms of employment numbers and turnover and things like that.
Yeah, okay, just to kind of add to Gary's point, and the points made by Dennis as well, I completely agree that the financial model needs to tell the story. and you know, and there needs to be kind of, you know, strong alignment between the story you're telling or the opportunity that's there and what the figures are saying. So you know, I'm kind of conscious as well in terms of the audience. There may be people that are at that early stage of their business. There's people that maybe at a later stage that are at the stage where they can pitch to the likes of HPAN or ourselves. So what I'd say is even at the early stage, if you're you know, at that, you know, I haven't quite progressed my idea or at my concept stage, and maybe you don't have a background in finance, you know, go to your local enterprise, and they will even provide you with a mentor to help with the financial planning side. So, you know, get the expertise if you don't have it yourself at the outset. And then, you know, as Gary was saying, you know, absolutely, you know, the last thing we want to see in Enterprise Ireland is a founder or someone coming looking for, you know, significant investment, and you know they can't walk you through their financial model. So what I'd say is get advice and get it early, because at least then, you know, if you're starting to build your own kind of skills and understanding on finance. I mean, you know, it's a lot of things that, you know, that an entrepreneur can sometimes shy away from if they don't have financial background. The last thing to worry about maybe is the finances. But if you can get that mentor or expertise, you know, mentoring is free of charge generally through the local enterprise. So, you know, get that support early on. If you're an Enterprise Ireland HBSU stage client, you know, we can give that support through mentoring or also through our business and financial planning grant. It's a 5K grant. We launched last year. It's still available. So I said to anyone who's a HBSU client to talk to their advisor about that. So you know, from our point of view, then there are particular things obviously that we would look for in terms of, you know, we want to see expert sales, you know, split out. Mightn't be, you know, as important maybe to other investors. Although if someone's looking for a scalable opportunity, it's generally an expert-led opportunity. I think from an Enterprise Ireland point of view, obviously as well, you know, we are obviously keen to see the level of detail on, you know, the job numbers, etc., which would be, you know, maybe a bit different to what maybe a private investor might be less concerned about that particular piece. But what I would say is, you know, as Dennis was saying, getting the model right, getting the assumptions right, but having a model designed in such a way that you can you know, change assumptions. Your story is always going to change. You know, your pricing model may adjust. You might have a proposed revenue model and then realize as you start talking to customers, okay, we need to tweak and switch that. So, you know, a financial model, it needs to be agile, and it needs to be one that you start to get comfortable with, so that when you are at that point where you're pitching to the likes of the HPAN investors or VCs or anyone, or even talk to Enterprise Ireland, you can comfortably talk through the figures. And I think that the important thing as well is understand the audience. So, you know, as Dennis was saying as well, whether you're an established company or a startup company, understand, you know, who's sitting across the table from you or across the the Teams call at the moment or Zoom call, and what they want to understand. So if you're looking for investment or funding or even early stage funding, you know, what are they looking for? What level of information they're looking for? And one thing I will say from an Enterprise Ireland point of view, one thing we're always looking for is if we can get an up-to-date accounts. So getting into the practice of doing accounts early, even if there's, you know, some companies would say to me, listen, there's not an awful lot there. There's not an awful lot in the balance sheet, but it's even just to show we can see what costs have been incurred already. So I'd certainly, you know, advise anyone maybe at the early stage to start getting that mentoring and support early on. There's some fantastic financial advisory firms out there, like the likes of Dennis and others. And if you're an Enterprise Ireland client, we can help match you and get you connected with the right expertise.
Okay, cool. One of the things that in working with clients is the timing of getting investment, and Dennis kind of touched on it earlier there, that the projections must build in the funding requirements as the business is growing and scaling. What, you know, in terms of promoters thinking and planning for investment, the right funding at the right time is vitally important. You know, sometimes there's a rush, and Terry, you kind of see it. People say, I want to be an Enterprise Ireland client, and then there's funding mechanisms that you have, maybe they're too early for. And the same, Gary, you probably see it as well. Companies say, I want angel investors, and they're going too early. Maybe, Gary, I'll come to you with this one. So about getting the right funding at the right time as part of your funding journey.
Yeah. So I suppose from a founder's point of view, that's about focus and a good use of your time as well. So I think you need to acknowledge where you are at in a funding journey and focus your energies on the most appropriate source for the stage that you're at. because you can, raising investments takes an awful lot of time. And even when you're ready, it takes a lot of time, and it's probably a close to full-time commitment for the CEO of the company. It's crucially important to that organization, so they need to spend that time, but spend it at the right time rather than go too early, spend a lot of time, and then you're just distracting. Like, it's very hard to give a definitive, this is exactly what you need to be at before investors want you. But as a rule of thumb from HBAN, they will want to see a product, they'll want to see it deployed with customers, and they will want to see that it's generating the right value for that customer, so it's fixing a big enough problem, and that you've got traction, and that traction, ideally is significant revenues starting to build with multiple customers. But it can be many, many things. It can be a number of proof of concepts that have been signed up with the right customers on the right terms. So, it's up to the founder to demonstrate why the traction that they have makes them investable. But you need to be at that stage where you've got a product, it's deployed, it's generating meaningful value for a customer, and you're starting to generate revenue from that, or significant commitment in terms of engagement from a customer.
Okay. And are we saying, Gary, as well, that typically startups, are they funding themselves for that first 18 months? Is that the typical time horizon, and then in the meantime we're looking then at the follow-on round? Is that a good rule of thumb?
Yeah, so I think how you get to that point can vary for many people, depending on your own personal circumstances. You have some founders who can self-fund for that period. Friends and families tend to fund a lot of this as well. So you do have investment, but it's not on professional investment terms. It's mums and dads and aunts and uncles and friends willing to back their favorite son or favorite nephew or whatever. And there's also the likes of competitive start funds. There's great support in the local enterprises offices, and through the BICs, there's a huge amount of support that isn't necessarily just pure financial, but it's the advisory and networks that they can bring to it as well. So there's lots of support, and it's worth actually probably just starting with the likes of yourselves and sitting down with your local BIC and just saying, well, what are the supports that are available, and how do I go about getting them?
Exactly, and yeah, we do a lot of signposting with clients. And Dennis, when you're helping the client and compile those projections, sometimes is there a fear factor that, as you're building the model, that the numbers that are being churned out in terms of funding requirement kind of frightens the promoters a little bit, and they're saying, oh God, because we get sometimes people saying, oh, I'm asking for this amount because this is what I think I can get from investors, that try to nickel and dime it. But we're trying to say, look, if the business model is X, then it will require X type funding. And how do you communicate that back to the promoter in developing those projections?
Yeah, I suppose what we see is that, like, there's a trade-off between a kind of evaluation conversation and what do we need funding wise to get us to the next milestone or hurdle that in our business. So it's trying to define that, to say, well, in order to prove, like, I've never seen a set of projections that don't have a stretch goal. Something, no one presents projections that shows a downward trend, or here's where we are, this is where we're going to stay, and this is what we're valued at. I mean, that's my previous life with commercial financial assets. So, but in growth companies, you have to demonstrate growth. So part of that is trying to make sure that, look, you have a plan from now to the next milestone, and that plan then requires a degree of fundability, and the money that's required then is a trade-off between the amount of dilution that you're willing to accept, and that by default sets a valuation that you either are or are not willing to accept also. So there's a number of issues that are going on, but you have to be able to say, look, I'm going to get from A to B. This is what I'm going to prove during that period, and either it's an advance in the proof of concept, or your reference customer is going to turn into a pool of customers, or whatever it is. Here's why we need the money, and based on that, that would lead to a potential valuation that we're willing to live with, or that we're going to shoot for. and therefore we're going to try and attract people in the door. And it kind of is what it is. So I see relatively modest valuations early that are not really valuations. They are look, we'll kick the valuation down the road to when we actually do an equity round where valuation is set. So it's going to be some form of convertible instrument. And really all we're talking about now is we're talking about raising as much kind of adequate money at the moment to get us to that milestone. To when you've actually hit milestones, then you get into a real sort of conversation around, well, what are we actually worth? We've got something here on the table. You know, we've proved ourselves at these various milestones. Now, what are we actually worth? And you get into a far more sort of detailed valuation discussion. So we see a variety of them, but it's just trying to articulate where they are at the moment. What do they need for the next stepping stone, and what does that mean?
Okay, cool, thank you. And we have a question. I'll just take a question from the audience there from Martin Jones, and maybe Terry, you could be knowledgeable about this. Is what would be the very first funding source a new startup that's at idea stage go for?
Okay, so it depends on the individual's perspective, and it is all about, sometimes at the early stage it can be, you know, stepping stones. So how much funding do I need to achieve, you know, some of the fundamentals maybe. So there's quite a number of kind of state type supports at the early stage. So, you know, there is the New Frontiers program. While it's a small amount of money if you get onto phase 2, it is 15,000 stipend for tax-free for 6 months. So with New Frontiers, for example, you can, you know, you get the training and the upskilling and, you know, the network with the technical university or the IT and the and your peers. You can do that program while you're working full time in your existing business, for example. And then if you progress to phase 2, that's when you're offered the stipend. So that's kind of mainly covering your own costs as an individual. If you've incorporated a company, there's some feasibility supports available from local enterprise. They're typically, you know, 15,000 and 50% grant rates. If the company is a little bit more progressed and maybe at a minimum viable product stage and potentially maybe within a year of seed, and it's an innovative company that meets Enterprise Ireland's criteria, you know, we typically can give feasibility supports at the early stage. At the moment, that's at 15,000 at a 50% grant rate. There's also you know, smaller supports that we can give, like innovation vouchers. Actually, you don't have to be an Enterprise Ireland client to get that. There are, you know, co-fund vouchers to get work done through the third level institutes. We also have, as I said, the 5,000 business and financial planning grant for all clients, even if they're early stage Enterprise Ireland clients, and that's 100% funded. So I think, depending on the stages you're at, but if you're literally at the outset, your first protocol is really your local enterprise, and they will signpost you from there. And if they can support you with particular financial supports, you know, they will do. And if you're that bit more progressed and kind of closer to your seed stage, maybe ready for Enterprise Ireland on board, there are supports we can give at the early stage, other than the, you know, the competitive start fund I spoke about earlier. That's open call approaches, competition. You know, some promoters will go for that. Others may decide, well, listen, I'll just kind of go through the normal system through local enterprise or through Enterprise Ireland. But the main thing is to be aware and to understand the support structures that are out there. And I think Aidan and his team, particularly anyone in the Southeast region, as Gary said, you know, first port of call in terms of signposting. And one other thing I'll just mention as well, we're actually launching today our Start in Ireland information portal. So it's www.startinireland.com, and that's a portal that will give entrepreneurs insight into the ecosystem. And depending on what stage you're at on that startup journey, you just feed in your own particular data or your own kind of asks or interest areas, and it will feed back to you, you know, what particular support structures or organizations may be there to go to. So it's almost like a virtual signposting. So just to let everyone know, I'll pop it into the chat, yeah. But that has been launched in live today.
Brilliant. That should prove to be a great resource.
Sorry, if I could just add to that, you know, we would be remiss if we didn't say that the best form of first funding is customers, and it's customers.
Oh, absolutely.
I think we should all challenge ourselves to actually try and do that. I know it's immensely hard, but if you can identify a customer's problem and it's so big to them, lots of times they will find ways of prepaying for their product. co-creating it with you, or even you provide a solution to it as a service while you build a product. And lots of people don't think enough about that, about how they can actually generate revenue from customers to start a bit of momentum behind them.
Yeah, no, I completely agree with Gary there. And I think, you know, at the early stages too, some companies can maybe get too bogged down in what state supports. And I know obviously from the state system, I will kind of point to state supports, but certainly there's nothing like getting a bit of customer traction. I did speak to a company in recent weeks and they said, no, their first priority was, you know, get some element of sales, get the product out there and start, you know, almost self-funding to some extent. And it really stood to them because it meant then that by generating some level of sales, even if it was trial customer, that made them more attractive to raise investments down the track. So, you know, completely agree with Gary on that point. And, you know, and you know, if that's where someone needs help in terms of introductions to potential customers, by all means, you know, link in with your mentor network and Enterprise Ireland to see how potentially you might be able to earmark or get the research done to earmark the right customers.
Exactly. And Terry, just there, you might stop and restart your video. You seem to be frozen there. Yeah.
Okay.
One of the questions I had asked, and it's just been asked there by Richard there, and kind of Dennis kind of touched on it earlier, and Gary would be very familiar, I suppose, in front of angels. What are those typical questions that might be asked to get to the core of your financials that any promoter startup out there should kind of be ready for and be ready to answer in terms of somebody questioning your financials? I don't know who wants to jump in there. Dennis, maybe?
Sure. Yeah. Anything from who left you in here to really a detailed kind of deep dive on, that's more to me, to a deep dive on the numbers. I suppose the way I would answer that, where you kind of get pulled apart, let's say at a meeting, is what I come across is I come across a lot of people who have sort of gone forward in the model and are looking at the metrics that the model is providing. So take it that it's a large numbers, large profits, everything is going great. But within those, there are metrics that you still need to be able to identify to prove that you have a scalable business model. So you have to get, let's say if it was in the SaaS arena, you will be trying to demonstrate, look, what your total contract value typically would be for customers, how much would that sort of translate to on an annual basis, what the cost of actually acquiring those customers will be, and then what your expectation will be around things like churn, and whether it's churn within different cohorts or what type of churn it maybe is, okay? So it's just knowing that those variables within that and sanity checking that if that's what you've got, then you can actually stand over that, because then you bring it back to, well, okay, well, what are our metrics day one? And they'll slightly change. You'll want, you'll have probably no churn in the first couple of years because you have very little customers, but you'll end up in a scenario where, and you'll be servicing them to death. So your issue in the first couple of years is your cost of acquisition and the cost of servicing the existing customers that are more reference based. When you get into a more normalized structure, then you have to be able to demonstrate that your model can show the levels that they're looking for in a business that they want to invest in, which is they want a low churn, they want a high TCV, they want an annual contract value that is billed up front as opposed to billed on a monthly basis if possible. So they want to see cash generation. And it's really just you being able to demonstrate that that's what you can do. So, and how that comes out is then you're demonstrating that you understand the relationship between cash and revenue, and you're understanding the relationship between growth and not growing broke. So a number of companies can put together numbers that look like they're growing broke, which means the more business you do, the worse off you are, because you've got to demonstrate that the more business you do, the better off you are, because your margins are getting better, your variable costs are getting better, and your fixed costs are staying put. So I think they're sort of the key items to me back of the envelope that I need to be able to demonstrate and sanity check in a model over a number of years.
Okay, Cool, thanks, Dennis. And Gary, typically, I know that there's no such thing as a typical business angel, I suppose, but what kind of questions do promoters get asked by angels in terms of interrogating the financial model or the financial projections?
Like, I think it is the unit economics for that particular business, just to really understand that. And that is, you know, specific to that business. So understanding the customer acquisition cost is really, really important, and all the levers that apply to that. And definitely looking forward 18 months or 2 years time, too often you just see the customer acquisition formula staying the same for the 5 years. And the reality is you'll probably be targeting different types of customers. You'll be selling to them in a different way. So again, it's just showing that building credibility that you know that your business is going to evolve and what the implications of that change means for the financial model. You know, how sticky is your product? What is the churn like? If I'm selling to enterprise customer as opposed to an SMB, well, what does my sales team look like? What does my marketing tactics look like? You know, anybody who's run a business like that knows that they're very, very different types of channels of distribution and channels of sales, and there's different costs associated with them. So again, it's not necessarily about having the right answer. It's about showing that you've identified all the key assumption areas and that you've got some answers at the moment on those. And then this is a tool that evolves, and you can update as you have some data that backs up those assumptions.
We're just going to go into Q&A in a second, but just, I suppose, one last question, and a kind of, it hopefully encapsulates some of the areas we spoke about. We could speak for much longer, and there's lots of other areas we could go into, but so just kind of from each of you, I suppose, you know, what are the common mistakes you see in the area around financial planning that promoters are making and typically making, just as kind of a learning point for people that are in the audience this morning? What are the common mistakes we see in projections?
Do you want me to?
Yeah, Terry, please.
That one? Yeah, I've been kind of working on reviewing financials for many years, so you know, I'm been a good opportunity to get the kind of the feedback back. I think it is very much around you know, presenting something for your audience and being clear about what they need to understand. I think if you're kind of a more established company and you've got a bit of a track record, I think always have your accounts up to date. And if you're presenting projections, you know, have your historical and your projected kind of connected. You know, I've often got business plans in, and I've got projections with you know, some basics with you know, no start date on them, or I've been told that they were presented like they were prepared a year ago. So they're presented year 1, year 2, year 3. I mean, that might sound very kind of obvious, but you'd be amazed at the extent to which, you know, some of the fundamentals aren't there. I think having background assumptions is really important as well. And, you know, so the person really, especially around things like the revenues, the breakdown of the revenue split, the revenue model, the pricing model, have that in the background as well. There's the fact that the assumptions can be agile as well, that, you know, if there is scope to change, you know, if the story changes, that's evident in the model as well. I think, you know, from an Enterprise Ireland point of view, and typically on the kind of HPSU investment side, especially at that seed stage, you know, having the projections reflect, you know, when's the likelihood of the co-investment maybe coming into place. You know, often, you know, it could be missing in the projections, or it's there, but it's not clear if there's a scheduling of that. I think on the revenue side, you know, we even have background information and assumptions around, okay, what customers are we talking about here? If there's a total figure in there, is there a pipeline of customers behind that? So I think that there's a level of you know, of information in terms of the basic, you know, accounts and projections, but there's always a layer behind that, which is the kind of the assumptions around some of the key measures, and particularly around pricing, revenue model, and the investment timeline. And it is as well to show that you've done some sensitivity as well. So if there's scope to look at some kind of sensitivity aspect in the model, I think that's important as well. And I've mentioned it earlier, for anyone who's an Enterprise Ireland client, the business and planning grant support does kind of build in that support from a provider, that they can help you build that model. that you can work with thereafter as well. So they'd be the key things for me.
Brilliant. Thank you, Terry. And Gary, the common mistakes you see in the I'd say that the hundreds of business plans and financial projections you've seen over the years.
Yeah, I go back to the credibility comment I made earlier, and one where it falls apart really, really quickly, very, very early on in the conversation, is the existing revenues. So they come in with existing revenues and then are extrapolating from those. But you very quickly start to dig into those revenues. You start to talk about what type of customers are, and there's a disconnect between those types of customers and actually what they're forecasting in the future. And that happens so often. So it's not about having a particular number in your spreadsheet. It's about what that number says and what it represents. And too often, that and extrapolating something that just doesn't stack up. And there may well be an opportunity in what they're forecasting going forward, but I'm starting to question whether they really understand, how they got there in the first place.
Okay, cool. And Dennis, I suppose you're at the coalface in assisting entrepreneurs.
Yeah, I suppose I think Terry and Gary have kind of highlighted the commercial aspects. I'll just give you the mechanical aspect of it, and that is this kind of sloppiness around the model doesn't work. So I suppose one of the kind of key tricks to getting financial models to work is to not try to project the bank balance all the time, right? So to not try and create a what is the cash implication of everything. Let your model actually balance to cash. So what that means is you prepare a profit and loss account. Your balance sheet could be zero for everything if you wanted to, but let the balance sheet balance to the cash figure. So the balance sheet will always balance no matter what. And it's the bank figure that balances it all the time. So just build a formula that basically makes the bank balance the balance sheet. So what that forces you to do is your balance sheet will never be out of sync. And if you've got a cash flow running off it, then it'll always be in sync. Your profit and loss will be generating it. And then you can tweak all your assumptions and your model will work fine. So that's how software financial planning model works. That is not how anybody builds a financial plan on a founder basis, because they're trying to look at every single item and then say, well, what would be the cash impact of that? Forget the cash impact of it and just let your balance sheet balance to cash. So that way, you're just from a mechanical perspective, your model will work. It doesn't mean the numbers will stack up, but it's good to get your model working to start with. So
I think of all the things, and I'm a financial background myself, but the one thing that promoters get really frightened of, they can handle the cash flow, they can handle the P&L, they can muck around with those. The balance sheet frightens the bejesus out of promoters. Is the one technical part of the whole thing that really frightens people, I think.
Well, it's confusing because it's a profit and loss is a time period.
Yeah.
Cash flow is a time period, and a balance sheet is a point in time. Yeah. So it's on a particular date, and that kind of goes, well, how does that work? So I suppose, look, it's just the way the three sort of systems interact with each other. It's relatively straightforward when you get your head around it, okay? But it's it can be and that's why people start with cash flows, so they start with P&L, and they have difficulty in trying to translate it into the other models. A little bit of help, phone call to some friend who kind of understands financial modeling or the accounting side of it, and then just try and make sure that your model is set up so that it actually self-balances the whole time. Good starting point, then tweak all your assumptions. So that's kind of where I see the needs.
Thanks very much, guys. Rosemary, do we have some questions I see there coming in?
Yeah, we do. I don't think I've ever seen Aidan smile so broadly as when he's listening to Dennis talking about balance sheets balancing.
Yeah. Sometimes it can be lonely, and myself and Siobhan are fighting the financial planning battle in the big. Go on.
Exactly. Yeah. There's a lot of questions, and we're not going to get through them because time is of the essence. But I have a question here. It's a bit technical, but would you recommend a CLN, convertible loan note, or direct equity, or does this depend on the type of company? So I suppose, Gary, maybe that might be a question for you.
Yeah, well, I suppose I can speak from the types of companies that get investment from HBAN. So a CLN is used quite often, and just so that people understand that it is hard to put a valuation on an early stage company that everybody can agree with. So I suppose a tool to kick the can down the road a little bit for everybody is an agreement to take a percentage when somebody in the future sets a valuation. So usually it's the round after this investment, and you operate on a discount against that. So it would be like a 20% discount at the next round of investment. There's lots of I suppose ways of it also combining that with evaluation. So they have tools like putting a cap on it, so the next round will be in a certain range of valuation, and if it's above or below that, there's implications for the investors. So it actually tends to boil down to the investor. Different investors have different preferences, and some may insist on equity only, and you just have to get comfortable with the valuation for that. A rule of thumb I have is that every round of investment is you're going to end up giving away between 20 and 30% of your company. It's up to you how much money you raise for that, and you need to have a justification for why that amount of money will get you to the next milestone. So it's always forward looking. So you're either going to get to sustainability with that investment, or you're going to get to another round of investment. So a lot of it boils down to the investor. Most people use CLNs at the moment in the market because it does deal with the challenge of putting a value on a company at a very, very early stage.
Sure. And this question is more for Terry. I think the question is, what type of investment is best for a startup? 10% equity is a lot to give away for 50K. So referring, I think, to the CSF conversation earlier. Is there any other benefits that come with this?
Okay, yeah, as I always say, Enterprise Ireland is not always just about the funding. So, if someone is successful in CSF, they get assigned a development advisor, and they can leverage other supports, if it's non-financial supports, through Enterprise Ireland, access to overseas offices or market research centre. There's other, maybe that 5K financial planning grant could potentially be an add-on at some point, but it's very much about the expertise. The advisors in Enterprise Ireland are sectorally aligned. They've got good expertise, so it's not always just about the money. So I will point that out, and I think the guys made the point earlier on that it's as much getting the right advice early on as well, and you could spend your money badly. So I think a huge benefit. I know a lot of people focus on the percentage of equity in CSF and etc. But there is a lot of kind of non-financial support that and advice and network access that goes with being an Enterprise Ireland client and get that CSF investment. So I would say not every company that comes on board in Enterprise Ireland, you don't have to get the CSF to come in the door.
Mm-hmm.
We do review companies continuously through our inquiries process, but sometimes we onboard and give feasibility to. So just to point that out as well. But there's a huge kind of non-financial benefit there, and we did a session with our team yesterday internally, and quite a number of companies that benefited more from some of the non-financial supports as the financial. Like, while you always need money, and money is important, but spending that money wisely at the early stage is important as well.
Okay, and I'm going to ask one last question. One last question. I'm going to pitch this one to Dennis. In your experience with your client base, where did your clients find that initial investment, that early stage investment? Was it friends, family? Was it seed investment? Where was that initial stage?
A range. Most of the time where we've come in to start supporting clients is they generally raised EI support. They're past friends and family. They've raised EI support, and then they're now in a seed and a VC round where they are, growth is really sort of on the agenda, and you're into kind of what I was talking about earlier with regards to kind of this real in-depth sort of discussion around valuations. The key to me is, like, EI, to me, like the money in a certain degree, it's very important, but it also, EI brings a huge pedigree to the share cap table. So, like, we see international investors wanting EI to be on the in the share cap table, because it really demonstrates that strength, that your proposition is sound. So it isn't just the money, absolutely not. It's the credibility factor too when you go for the next round. So we see it at all stages, but we mostly come in at the VC stage where the rounds are getting heavier.
Okay, great. Is it? There's more questions.
There
We
is,
could
I was
stay
just
here
going
all
to say,
day. But
yeah, we could, yeah. And I would, anybody who, apologies, who didn't get around to, you can contact us directly here in the BIC and we can get answers from the panelists maybe.
Yeah, I actually can't type them in here, so I was.
No, that's, we can get to those later. So do contact us directly and we can get those answers for you. So listen, we've reached the end. We've gone slightly over, and apologies for that. We promised the hour, just gone slightly over. My big takeaways from today's was get the expert advice around financial planning. It's really, really important. It's a technical area in terms of getting your business plan, the complete business plan together. Start the financial planning process early in the whole process. Make them realistic. That only improves your credibility in front of investors of all types. The unit economics, get those right as well. And that it must be part of the business plan. It must match the rest of the business plan. The qualitative and the quantitative must match up together. So listen, thanks to everybody for logging on this morning. A special thanks to Terry, to Gary, and to Dennis. Thank you so much for giving up your time this morning and your experience and expertise. It was fascinating. Personally, I could talk about this all day. It's a topic close to my own heart. So thank you very, very much, guys, for coming on this morning. I really do appreciate it. Thanks to the team in the BIC here in the background, all squirreling away, and for promoting it for the last few weeks. Thanks, guys. I'd encourage anybody logged on this morning, sign up for our newsletter. It's a monthly newsletter packed with information about the ecosystem, about events, and other stuff that's of interest to promoters and startups in the Southeast, but also at a national level. And do check out our YouTube channel, Southeast Business and Innovation Centre. All previous webinars and all future webinars will be on there as well. So listen, thanks very much to everybody. Stay safe, stay well, and we'll talk to you very soon. Cheers. Bye-bye.